Hello students, I am Dr. Shrikant Bhavse, Assistant Professor at Department of Advanced Management Studies, GS College of Commerce, Wardha. Today we are going to study the future trading strategies. Remember that this is one of the most complex, complicated and sophisticated financial instrument. If you are able to understand this instrument, if you are having adequate knowledge of technical analysis, if you are having a deep, thorough understanding of this instrument along with the experience, only they trade into the future segment. So, being the student, you should understand the future trading strategies. The future trading strategies involve long future, short future and the bull calendar spread strategy and the bear calendar spread strategy. So we will start with the long future contract and the short future contract. We will long any future means we will buy any future only when we are bullish on that particular underlying asset. Imagine that if you are seeing on the charts that a big green candle is getting formed with the huge volume, and if there is a positive breakout, all these things are showing the bullishness. Along with this, if the volume is also huge, at that time you can buy the long future contract. For this, you will also have to use the indicators. You should know the use of indicators while buying the futures contract. So there are different indicators such as relative strength index, moving averages, convergence and divergence, then ADX, then Bollinger Bands. So there are different types of indicators which you will have to use along with the Japanese candlestick chart patterns. So when all these indicators will show you the great strength on the chart, at that time you can say that the stock is bullish. Only when you are 100% confident on all the parameters, buy the one future contract of that particular underlying asset. When you are buying a future contract, remember one thing, you are exposed to unlimited risk, because if it goes against you, you will be making exponential loss, and if it is going in favor of you, you will be able to make handsome profits. So the first criteria for going long in a future contract is it should be bullish. Then you should have a great knowledge of technical analysis, and there must be a positive breakout. This positive breakout is seen on the chart, that if the market is say range bound in this way, and all of a sudden if there is a big huge green candle you see with the huge volume below it, at that time it will be considered as the positive breakout. For example, this positive breakout may be on the monthly chart, on the 3 months chart or 6 month chart, or even on an yearly chart. Then this breakout should be with high volume, because if there is a low volume, that will be a false signal. So that breakout should be with the high volume, and there must be high open interest. Open interest means number of positions, long or short, added in a single stock or in the index. So there must be high open interest which will show the interest of traders or investors in that particular stock. Then there will be moving average, there will be exponential moving average, there will be simple moving averages, say of 15 days, 21 days, 30 days, 45 days. That should be broken with the breakout. So only then we have to go long on the future contract, and whenever we are entering into the future contract, we must maintain a stop loss, because these are extremely risky instrument if you are not maintaining a stop loss, and if the position which you have taken goes exactly in the opposite direction. If market goes exactly opposite of your anticipation or prediction, you will be making huge losses. For cutting your losses, you should have a strict stop loss. In the stop loss, you have to find the nearby support for keeping your stop loss, and below that support you should always keep some room, because many a times it happens that your stop loss get hits and again the stop goes up. So there should be some room between the support for the stop loss. Now the next strategy is of short future. If you are bearish, if you are thinking that the stock is not performing well, the stock is going down with huge volume, you should have here also a great understanding of technical analysis. If there is a negative breakout, means huge red candle along with the high volume, high selling, and if again open interest should be extremely high, this will show that huge number of traders and investors are dumping that particular stock, and it should again break the moving averages. It should break its support. Here it should break its resistance. Here it should break its support. And when all these things will be coupled with the indicators, and all the indicators along with these things are showing negativeness on the chart, when you are 100% confirmed that stock is going to get down, only then initiate the short future contract, and that too with the stop loss. Here when you are buying a future contract, your stop loss will be below the buying price. When you are selling the future contract, your stop loss will be higher than the buying price. Then there are two strategies involved in the future trading. First one is the bull calendar spread, and second one is the bear calendar spread. These are very simple strategies. In the bull calendar spread, as the name suggests, you have to buy same month future contract, because this is September month. If you are entering into the bull calendar spread, if you are thinking that the underlying asset is bullish, if the market is bullish, you will buy the same month future contract of that particular stock or underlying asset. Along with this, simultaneously you will sell the next month future contract of the same underlying. For example, you are bullish on the Nifty, you will buy the September month contract, same month, September month contract of Nifty. Simultaneously, you will sell October month contract of the Nifty. If you are buying one contract of September month, at that time you are selling the October month contract, one October month contract. So you are bullish in September month and you are bearish in the October month. As soon as the time goes, there will be a spread, there will be wider spread between the prices of same month and the next month future contract. it will it may go in favor of you, that spread may go in favor of you. Say you will be making good profit in the buying contract in the same month and you will be making less loss in the next month. So you are exposed to risk here also, but your risk will be quite low. In the same way, bear calendar spread, as the name suggests, what you will do, you will sell this month future contract and you will buy next month future contract. For example, you are selling the September future contract of Nifty and you are buying the October future contract of Nifty. Here you are anticipating that in the near term, in the short term, the September future contract will go down and the October future contract will go up. But the downwardness of September future contract will be higher as compared to the upwardness of October future contract. So as this spread goes wider, you will be bound to make profit. But dear students, keep this in mind that this is extremely risky and the money involved in these instruments are extremely high. Though you can trade these contracts on the basis of margin, don't get fall prey to these things, because a slight variation in the market, or if your move is going wrong, you will be making huge losses. For cutting your losses, you must maintain a stop loss. So you have to spend time into the market, you have to take great experience, you should be filled with rich experience, you should do thousands of hours of practice, you should do the paper trading, you should read different indicators, different charts. Only when you are 100% pretty sure, confident that you can do these things, after great results on the paper trading, try to do these things if you are willing to take risk, and that too with the small quantity. Do not increase your quantity unless and until you comes in a profit, and trade with the strict stop loss. This is all for today. Thank you.